Good day. I'm Raymond Torto, Global Chief Economist for CBRE, and I'm with Bill Wheaton, professor at MIT and a special consultant to CBRE's econometric advisors. I hope you got to see Bill talk a little bit about long-term economic growth prospects in a video that, or I should say, a Global Insights that we released just a little while ago. And the thought was that we would talk a little bit about economic growth, but more in a time frame of what's the short-term outlook. So this video and this discussion is really, okay, you know, here we are in the beginning of 2013. There's a lot of concern that we're in a structural, not a structural, I should say a cyclical downturn that's not going to get much better. It's just going to get better quite slowly. So Bill, I want you to kind of maybe use the same metaphors you did before, headwinds and tailwinds, and sort of talk about what are you seeing in the short run with regard to the prospects for economic growth around the globe.
Okay, thanks, Ray. I think over the next 5 years, maybe 10 years.
Stay 5 years. Stay
five years. Yeah. We actually have more tailwinds than we have headwinds. So let's talk about the tailwinds first. Economic growth in the short run is very much dependent upon increases in consumption, people buying things and consuming things. And here the prospects for consumption depend very much on whether you talk about the emerging markets as opposed to the developed world. In the emerging markets, the savings rate is 30, 40, in some countries 50%. And many economists believe as these countries continue to grow, the savings rate is going to fall, which means the consumption rate is going to rise. And as the consumption rate rises, the absolute level of consumption in these countries is going to grow quite rapidly. So I'd be quite bullish on many emerging and mid-level countries in terms of their short-term outlooks for economic growth, because consumption growth is going to be quite strong in those areas.
That seems to be sort of, as we would say, priced in terms of as you look at the real estate prices around the world and the emerging markets as opposed to the mature ones, wouldn't you say?
Well, whether it's certainly the question of whether it's priced into stocks and equities is another question.
We're talking real estate, Bill.
Real estate, I'm not really sure, particularly in terms of housing. As these countries, as the consumption rate rises, more and more consumers in these emerging markets are going to want better and better housing. And that could be a huge stimulus, again, to economic growth. The problem comes from the developed countries, which have much lower savings rates, 2, 3, 4, 5, 10%. And so there, the only increases in consumption that can happen come from income growth. You don't have any change in the marginal propensity to consume. The U.S. is particularly problematic here because our savings rate is close to zero. And really the prospects for consumption depend purely on income growth in the United States. One little bit of a silver lining here for the United States is the housing market. As the housing market recovers, which we're increasingly confident that it will, that's going to free up people that have negative equity, return them to positive equity, increase spending, also help generate GDP just because of housing construction. So recovery in housing markets, particularly in a few developed countries, will be a boost to consumption. The second factor I think that's really at work, that's very, very important, is continued growth in international trade. In the United States over the last 25 years, the ratio of imports and exports to GDP has increased from 12% to more than 30%. We have just become a much more open country, exporting more to the rest of the world and importing more affordable goods and products and services. And other countries around the world have too. There's just been a huge increase in what economists call global trade and openness in economies. And when you have that kind of movement in openness, you get increases in economic growth just because countries specialize in producing things they're really good at, shipping them to countries that consume them, and countries specialize, and there's what's called the gains to trade. And I think economists think that, you know, at least for the next decade, we can continue to have gains from trade with increasing specialization and trading between countries. No country seems to be trying to move into a protectionist mode, and everybody seems to have really All countries seem to have bought into the idea that free trade is just a very important way that the global economy can grow. So that's a tailwind too. The one headwind that everybody sees is the level of public debt. Many countries, many developed countries now have ratios of debt to GDP that are above 1. And this causes concern because the debt that the public debt that a country builds up has to be serviced. And so you have to raise taxes and pay investors who lend you the money, even if it's your own citizens. So you have to service that debt more, and so as the ratio of debt to GDP climbs, more of GDP is used to service debt as opposed to buying cars and food and clothing. And so that's really a drag on GDP growth.
Doesn't that depend greatly on what the interest rate is?
Yes, and the country that has the highest ratio of debt to GDP is Japan. There it's about 2.2 times GDP. And the one thing that saves Japan is the fact that they have interest rates of 1%, 1.5%.
0.25.
If you were short-term rates, if the Bank of Japan is successful in reinflating the economy to increase economic growth, the problem is going to be that the cost of servicing their debt is also going to go up. Everybody's worried that the buildup of public debt will be a drag on economic growth, and with some, really very, very good reason. There's a little formula that's often used, which is the growth in the ratio of debt to GDP depends on the current government deficit rate, 4, 5, 6, 7, 8% of GDP, minus the growth rate in GDP. So if a country right now, the United States, has a deficit rate of 9% of GDP, and we're growing at 3%, which means our debt to GDP is increasing every year by 6%. So if you want to stop that, the only way you can do it is you can either stimulate the economy to grow at 9%, which would never happen, or you have to lower the deficit down to just a couple percentage points of GDP, and then you can stop the debt ratio from increasing. So, gradually bringing down deficits is really a very important thing. The problem is if you cut deficits very sharply all at once, you create a Keynesian recession. If you don't cut deficits, you're sort of on a path to, an eventual sovereign default or doom. So you have to reduce deficits strategically, very, very carefully. And the way I think most economists would like to see this done is to raise what we call good taxes rather than bad taxes, and to cut wasteful public spending as opposed to productive public spending.
Those are in the eyes of the beholder, right?
Well, but there's some agreement on it. For example, I think most economists would agree that taxes on gasoline, taxes on evils like smoking, taxes on carbon, these are all what we call Pigouvian taxes that help encourage...
Pigouvian?
Pigouvian, from Auguste Piguet, a famous economist. And these are all taxes that discourage things that are harmful to the economy, like emissions and pollution and excessive driving. And those are in fact good taxes. Bad taxes are taxes on income and savings that discourage effort, that discourage savings. So economists would say, well, we should think about switching to something like a consumption tax. We should get rid of corporate perks. These are all reforms to the income tax. And then we should think about a range of taxes that help the environment, that help encourage people to drive less, create less congestion. And the taxes like that could actually raise a significant amount of money. And then when we think of what parts of the public budget to cut, we also have to be very careful that we don't cut the parts of the budget that help the economy grow. So not building a bridge to nowhere, that's a great cut. On the other hand, cutting very important forms of infrastructure that allow expending, that allow the economy to grow and allow people to transport goods and services, that's a bad cut, because that's actually going to hurt spending. Cutting pure transfers doesn't have much of an effect on GDP, on productivity, but cutting spending on schooling or research and development, does hurt productivity. So I think the U.S. Simpson-Bowles Commission had this sort of argument right when they said you have to very strategically alter your mix of taxes, and you have to very strategically cut expenditures. Unfortunately, not only in the United States, but if we look at Europe, there's not much of this strategic surgery going on. Everybody's just slashing budgets, raising taxes, fighting across the aisles. They're not thinking intelligently about the surgery that actually could be done to bring deficits down and at the same time increase productivity and not have serious recessions as we restore fiscal balance.
So that, in sum and substance, when you sum it up, your view for economic growth in the next 5 years?
In the next 5 years is very cautious. I think that consumption and investment can grow from trade and sort of Keynesian effects. I think it really depends on how we manage deficits. If we manage deficits wisely, then I think we can, continue to have growth like we have over the last decade. If we manage them foolishly, then I think we're in trouble.
On that note, I think we'll thank you very much, Bill, for your thoughts on this, and would love to hear from our audience in terms of whether you enjoyed listening to Bill's views. I always do, although I don't always agree with him, but I always do enjoy being stimulated by his thinking. So let me know, and thank you for listening to Global Insights.